Quarterly Market Insights webinar here in Q2. Joined here with Andrew Tudor. We're going to get started here in a second. We got some folks in the waiting room, so I'm going to go ahead and let them in.
That's good.
Hey, everyone, thanks for joining. Excited to be here. We will give folks a few minutes to continue to join here. It is 5:30, but we normally get started at 5:33. So we'll give them a couple minutes. This is well timed. It's been choppy out there. With a great start to the year. We've come back and now we've seen a lot of choppiness. So glad to be here. Looking forward to people's questions. What are you thinking, Andrew?
I think it will be a jumping Q&A session. I think there's a lot of economic data that dropped this week, and if folks are watching their portfolios, they might have some questions. So should be good.
Agreed. All right, we'll give folks another minute. Yeah, even though it's been somewhat choppy, we had a pretty benign day today. I think it may have calmed down. We saw a couple choppy days. Not that I'm looking at short-term, performance or anything short-term, but All right, we'll go ahead and get started. Thank you to everybody who's joining. For those of you who are watching this in recording or on YouTube, appreciate you dialing in. We're here for another installment of our Quarterly Market Insights webinar. I'm joined here with my teammate, Andrew Tudor. I'll let Andrew go ahead and introduce himself, and then we can dive in.
Amazing. Thank you, Jason. So I'm excited to be here. This is my first quarterly update and excited to continue doing them in the future. I come to the Zenith firm from running my own shop. So running my own firm, doing investment management, right around 8 years total. So excited to share, excited to keep working, and I'll kick it back to you, Jason.
Awesome. Well, we're excited to have you, Andrew. First and foremost, to hear some of your insights tonight. I really enjoyed how these webinars have materialized over the years. And just remembering that the key objective tonight of this webinar is to empower our investors with actionable insights, fostering continuous improvement in decision-making, and instilling confidence through a deeper understanding of market dynamics and emerging opportunities. So we've got some key takeaways that we want folks to internalize here. Going to start tonight with the takeaways before we start diving into the details. Maybe the first one, which we alluded to a little bit in the pre-chatter before we let folks in, is just being patient in volatile markets. Right, we've seen short-term turbulence, but historical data suggests that patient investors tend to fare better over the long term. For instance, in periods of market volatility, those who remain invested experience recoveries and avoided potential losses that may be associated with market timing. So, I think resilience underscores the importance of staying committed to long-term investment strategies, even in the midst of short-term swings. And even when looking at our clients, typically young families, institutions with long time horizons, this point is paramount. The second is really just effective portfolio management through diversification. Right, and we, want to make sure that we are crafting portfolios by, mitigating risk through spreading investments across different asset classes. So there may be U.S. investments, international investments, large company investments, small company investments, public investments, private investments, potentially commodities, and other things that allow us to have differentiated return streams in portfolios. Diversification enables people to capture opportunities across various market segments and really enhances the potential for long-term growth while minimizing downside risk. We see this can be tough, right? We look at like large cap growth here in the US has really dominated returns over the last 14 years. We've seen, kind of big swings up, big swings down. If you've been invested in long-term growth over that 14 years, you've seen a great, return. But in the interim, it's difficult to smooth volatility. And actually, if you look back over that 14 years, a globally diversified portfolio outperformed because you didn't see those same downside swings and permanent impairment on your portfolio. When you lose one, you got to make two to get it back. Then the last theme is just really capitalizing on themes and alternatives, right? So, finding emerging themes in the market to invest in. And I think looking for unique opportunities to seek growth and diversification. Examples tonight, we're going to talk about artificial intelligence, sustainability. We're going to review some potential alternative investments that highlight the point of risk management and enhance returns through alternative investments. So if anybody has any questions, please throw them in the chat. We're happy to answer anything. But I'll kick it over to Andrew maybe to get started on, just internalizing and conceptualizing what economic data we're looking at and how that applies to our process.
Yeah, absolutely. So when we think about economic factors that we take into account as we craft portfolios for individuals, families, and for institutions, we really want to think about, macro policies, monetary policy shifts, and then there are always some key factors that we have to be aware of. So when we look at that economic data, monetary policy is a big deal. We also want to think about how inflation and the dynamics of inflation. We'll have a slide later that talks about how inflation with the US dollar and how, the Fed adjusting rates more reactionary, but still with the hopes of not allowing inflation to run amok throughout your portfolio and throughout, the economic data. And then as we think about global growth, as we think about what it looks like over a long-term time horizon, we want to make sure we're extremely resilient. And one of the best ways to do that is through the diversification of not only multiple sectors and multiple geographies.
Well said. And, these three dynamics here, going back to even our market outlook presentation and piece that we put out in January of each year, these three dynamics are always in light for us, right? And we monitor these, economic factors and policy, inflation, and global growth through three key elements, right, that we track. So a bit of a busy graph, but you can dial down those three components into the U.S. inflation rate, right? That's kind of inflation dynamics, as Andrew alluded to. The U.S. dollar index, which is like global growth and moderation, and then the effective federal funds rate, right? And as we look at this chart, the green line is inflation, right? We saw really a spike in inflation, as most of us are familiar with. Coming out of COVID, we saw some pretty easy monetary policy that followed. And you can see the policy here in the blue line. So as interest rates dropped and stayed low, inflation started running extremely hot in the economy, right? And that means prices were going up. That means expectations for future returns were going down because they're being eaten up by inflation. But also because interest rates were low, the US dollar lost some value. So you can see here in the dark blue line, we've got the US dollar. And as the Federal Reserve here in the United States started to say, hey, we need to watch out for too high inflation, right? The Federal Reserve wants inflation around 2%. So we really haven't seen that since 2021, right? We don't want inflation running too hot. Once it crossed their 2% threshold and started moving up, they started moving interest rates up to combat that inflationary dynamic. Once interest rates started moving up, the US dollar followed suit because it became more attractive for foreign currency to invest in US currency because interest rates were higher as compared to other global currencies. So we've seen really high strength in the dollar. We've seen higher interest rates, and we've seen falling inflation here in this green line, but it's still not down to that federal fund target rate. So we've seen the Federal Reserve really hold rates steady over the last few periods, to the chagrin, I think, of growth-focused investors who want to invest in companies and projects that have earnings not tomorrow, but way out in the future. And these interest rates and this inflationary dynamic allows or forces those investors to discount at a higher rate those future cash flows, which has been a drag on growth stocks. And I think as we've seen even over the last few weeks, as investors really grapple with the fact that the Federal Reserve is still not at their inflation target and may keep rates higher up at this 5.33% for longer, that still may have a drag on investing in themes and projects and investments that have longer duration earnings and cash flows. Andrew, anything you want to add on that point?
I think as we look at 2019, we see that the Fed dropped rates back down to close to zero at the beginning of 2020. And we know that COVID hit and there was global crisis around that. But as we see that inflation rises, really what they're trying not to do is have another bounce back by dropping rates too quickly. So you're correct. There's a lot of investors, specifically folks who are looking for them to drop rates faster, thinking that inflation is down, which it is from its height of almost 9% back in 2022. But we're still looking at the fact that it's above the target. And what we don't want to do is see another bounce back of inflation because they drop rates too low. And so it's that, the soft landing they speak of, right? How do we drop rates, but also not drop them too quickly?
Absolutely. So this graph really depicts the relationship between interest rates and the federal funds rate, the US dollar index, and inflation over this given period. And it provides insights into the interplay between policy, currency, and inflation. And understanding these relationships is essential for investors and for portfolio managers like us as we assess the macroeconomic environment and, importantly, its impact on asset prices and investment strategies. Right. And that really dovetails into our thoughts on just capital market expectations. Right. So this scatter plot is illustrating the risk return profile of various asset classes. Right. And highlighting the trade off between risk and potential return. So the higher up on the chart you go, the higher, the more risk you're taking. The further out to the right you go, the more return you're getting. And understanding the dynamics of risk return and how that impacts different asset classes like US stocks, like emerging markets, like US bonds, like commodity prices, like alternative investments, right, is crucial to constructing well-diversified portfolios that align with your financial goals as an investor, but also risk preferences that you have, and maybe risk tolerance, and maybe the necessity of risk that you need in your portfolio to achieve your goals. So I won't hit too hard on this, but I will pause here. If anybody has any questions before we start diving into emerging themes and navigating the markets, please let us know.
We've got a question here in the chat that says, can you talk high level about the asset classes on the right? So what all, can you give a quick explainer for those?
Thanks, Andrew. So each one of these asset classes, I'll just go down the list and maybe turn these into maybe actionable thoughts. It's a great question. Thank you for that question. The first is in green, the S&P 500. This is US large cap stocks, right? The 500 biggest companies in the US equity markets. The second is the Russell 2000. That is the 2,000 biggest companies on the US market. So that does include not only huge companies, but also, smaller companies and mid-cap companies, some small cap companies. The lighter blue is the international ex-US stock index. We call it the ACWI, just based on the index name. It is showing us the performance of international stocks, but in developed markets. So as we consider developed, that is things like Europe, some areas of South America, versus in green, we've got the MSCI emerging markets total return. That is economies that are in emerging and more growth stage, but may exhibit higher levels of volatility. That can include areas like Egypt, India, Brazil. In pink, we've got the Bloomberg US aggregate. This is the primary US bond index and really represents, in my opinion, when you look at the underlying constituents, represents like global bonds, right? And how bonds are moving. In orange, we've got the municipal bond index. So this is not corporate bonds like the Bloomberg US aggregate, but is municipal bonds. So when cities or states issue financing and investors buy to finance the construction of bridges or toll roads or schools, right? That's what's included in that index and really represents, I think, the more infrastructure element of credit rather than the corporate element of credit. In light green, we've got the commodity index, right? And that's kind of, some of these that are on the lower end of the spectrum, we'll see like not really getting compensated for the level of risk that you're taking and not really getting the level of return necessary. And you want to be kind of up and to the right as much as possible here on this chart. So, commodities have been extremely volatile and not really exhibited kind of like the level of return that I think is necessary for the level of risk, along with real estate, right? I think like this is one that recently we've seen, some volatility, and real estate's kind of depicted in this darker purple circle. And lastly, we've got a lighter purple circle that represents the diversified alternatives bucket. That represents just alternative investments like private equity, private credit, some elements of real estate infrastructure. So these are the main asset classes that we're looking at as we think about constructing portfolios, right? And you can see that these are kind of all over the chart. So as we think about constructing portfolios, we want differentiated sources of return and risk so that if one asset class is down, for example, other asset classes may be up or holding steady or not down as much, like we've seen in the dynamic in international equities versus US equities here over the last couple of weeks. Great question. Thank you. All right, so we'll keep it moving. We reported out in our market outlook here in January just some emerging themes that are going to happen, right? As we look at our 6 key themes for the year, we discussed those 3 that I mentioned earlier: the US dollar, inflation, interest rates, but also these 3, right, to come up with 6 key themes: artificial intelligence, sustainability, geopolitical unrest. Andrew, do you want to maybe touch on artificial intelligence sustainability here, and I can hit on geopolitical?
Yeah, absolutely. So we are measuring artificial intelligence impact in the market through the NASDAQ CTA Artificial Intelligence Index. And what you can see is, from the beginning of 2019 on to today, it's up 154%. For relative comparison, the Vanguard Total Stock Market ETF is up 96% over that same time period. So what we're looking at is that by specifically investing in artificial intelligence stocks, they're outperforming the overall market by about 50% higher. And in a long-term portfolio, that matters, right? And so, there are some themes around, if you look at the S&P 500, or if you look at some of the largest companies in the world, but specifically in the United States, that this artificial intelligence bump is carrying the US stock market in a lot of ways. And you see that with some individual stocks like NVIDIA is one of the big ones that has been carrying over the last 5-6 months the overall S&P 500 because of the overall weighting. And so, obviously we want to include those in our portfolios going forward, and also find ways of, if someone wants to take a more aggressive growth trend, finding ways to input more and more of some of these upward trajectories in their portfolio. Sustainability trends, ESG standing for environmental, social, and governance. We are looking at, we're measuring that through the Fidelity US Sustainability Index. So over the same time period where the total stock market returned 96%, we're looking at 113% from sustainability. And this really does drive to the core of the ESG or sustainability investing trend. The premise says that if we are screening out all the risks that are involved with the companies that we're investing in, one of those risks is that they're not environmentally friendly or sustainable long-term. Other risks include that they don't pay gender equity, or they don't have good social justice governance or employee governance or corporate governance. And so if we screen out, or if we were to eliminate some of the companies that score poorly, that the ones that are actually hitting the number and thinking forward and innovating and being more inclusive perform better. And so, that's really the crux of looking at sustainability trends in the future and really looking at the companies that are performing well and that are doing their due diligence and being good to their communities, being good to their employees, performing better over the long term.
Great point, Andrew. We got a good question in the chat. Thank you again. What are the risks of me investing solely in the AI index versus having a more diversified portfolio? And it really comes down, it's a great question, really comes down to how much volatility and ups and downs you're willing to accept. So if you can see here in this chart, the green line is the AI index, right? We got a big scream up post-COVID. We saw a pretty big drop, more than 50% over the kind of in 2022, right? So, if we put this in portfolio dollars, right, you kind of earned up to 100 and now you're down to 50, right? When you got to 100, that was a 100% return from where you started, right? If you drop down to, less than 80 or in this level, you're losing 50%, right? You're down to $50. In order to get that 50% back, you have to earn 100% again in your portfolio. So while this is representing the index level, it doesn't represent actual portfolio math, right? And I think as folks look to invest their portfolios, limiting downside risk and having consistent, continuous returns allows you to compound returns and not have, portfolio detraction and permanent impairment on your portfolio. So I'll lead with that, right? Having a diversified portfolio will allow you to weather the storm. However, duration matters in portfolio. So if you have a Roth IRA, for example, and you are 30 years old, you got a 30-year time horizon before you can really take that Roth with any type of efficiency, I would suggest investing in longer duration ideas. And what we consider both of these emerging things in sustainability and artificial intelligence are ways that these are things that are adding productivity to our economy. So they're creating more value over the long term than in the short term. So allocating your money to areas of the market that do have that higher growth rate is extremely important. However, I'd say that if you allocate solely to our artificial intelligence, and our artificial intelligence does not actually turn out to be the next .com or the next kind of cloud computing theme that we've seen in the market, right? We may be in the second inning of a 9-inning game, but it may not make it past the third inning. So if you are allocated to that one sector, you may experience some significant drawdowns if AI doesn't pan out to be, or we see some kind of issues with artificial intelligence long term. So I think it just concentrates your risk to have more exposure to AI versus kind of, you can see this Vanguard total stock market will give you a lot more certainty. This is a 5-year runway. Looking at this over a 20, 25, 30-year period with trends that didn't last. I can go back and think about one that was pre-COVID, but publicly traded marijuana companies that were listed on Canadian exchanges screamed, and everybody said, "Oh, legalization is going to happen, right?" And all these things are going to happen that are going to boost this industry, right? And it really never really panned out, and we still haven't seen those stocks recover. And investors who invested solely in that sector took some pretty big losses, right? So that's a great question. Having a diversified portfolio is extremely prudent. And I think as you look for, opportunities to add alpha to your portfolio, may not be solely investing in artificial intelligence, but like what we do for our client portfolios here at Zenith is we have a little higher weighting to, technology, right? A little higher weighting to an exposure to artificial intelligence. But we still have those underlying exposures that add diversification in the portfolio. We didn't quite touch on geopolitical risk in this chart, but we do want to call it out as a theme. We see what's going on in the Middle East. We know that we've got a presidential election coming up here in the United States that oftentimes drives some varied stock market outcomes. It's hard to predict what's going to happen. We do know something's going to happen though. And these tensions can really impact global markets and investor sentiment. They really underscore the importance of having a diversified portfolio because some of the things that come from geopolitical unrest are not logical. The stock market is also a random walk, which means it's very difficult to look at history and determine what's going to happen moving forward. So even though you see this chart here, anything can happen. Regulation can come into AI. The political party in power may come after the big tech sector and implement, new compliance standards, or, same thing like they did with the anti-money laundering standards with banks. Coming out of the financial crisis, now banks struggle to have profitability. I think you may see or could see the similar dynamics here. So geopolitical uncertainty is really, really a key theme that we want to continue to look out for in the market. Thanks for the questions. I think this is part of the economic themes that we've seen, right, in the U.S. dollar inflation and interest rates. We have seen that dispersion post-COVID in different stock prices has really indicated greater variability in individual stock performance within the market, right? And what this means is heightened dispersion. So going from 44 to 64, 44 to 65, if we want to round, right? This heightened dispersion creates opportunities for people that are actively managing their portfolio to generate alpha by selecting better stocks and outperforming the broader market. Understand the implications of this is crucial for investors as you seek to capitalize on potential outperformance and enhance portfolio returns and reduce portfolio risk, right, in active management strategies. So we want to make sure we're being, prudent allocators to global markets in our portfolios at Zenith, right, that are diversified, but are looking for opportunities to add outperformance by allocating to things like technology, right, and artificial intelligence sustainability, right, but making sure we maintain a prudent diversification, but getting those couple percentage points of outperformance, like we said, really compounds over the long term. So Andrew, you maybe want to hit on one of our investment examples. I think, we've kind of talked at a high level. I think we want to get into some examples here that we've seen, add some value to our portfolios, but also quantify them with a risk score. So Andrew, I know you've had some experience with this one.
Absolutely. So NACP, it is a ETF that tracks the Morningstar Minority Empowerment Index, and it is that sustainability sleeve that we talked about. So all of the companies that are including in this ETF are scoring high on policies around racial equity and diversity in their policies in their workplace. And what we've noticed, so it has a risk score of 75 out of 100. So it is a large cap ETF. These are typically well-known companies, most folks would know. And that 75 score on the risk side is really outperforming a lot of the other comparable ETFs and comparable mutual funds with those same risk scores. So we have an internal process that we use to score these funds. And the scoring for the NACP, if I can share, in our last go round was a 4.0 on the GPA scale. And so I didn't quite get a 4.0 in school. And it's nice to see.
Wait, tell us what your GPA was, Andrew. Like, why don't we can go there.
Which school? So, school, I came out with a strong 3.6, but played a little college football, pledged Alpha, Martin Luther King's an Alpha. So that makes me feel good. So, a 3.3 got me out of business school though. So
nice.
How about you? Where'd you land?
Look, I landed at a strong 3.0. I'm proud of it. I fought for it, college football. I think as we think about GPAs at our process here at Zenith, right, we want to make sure we're looking at 3.7s or higher, right? The max score is 4.2. We take into account this risk score, right? And, we're looking at kind of the risk score as it compares to its competition set. This negative number 16 and positive 27 is what we would expect this fund to return over a 6-month period, right? So taking it back to high school stats, which I actually got a 4.0 in, these numbers represent everything within 2 standard deviations of the expected return. So expected return kind of, what we think is going to happen when things happen outside of that 2 standard deviation level. So we start to get concerned and make sure we're understanding what's going on inside the fund. I think NACP is a great example of who we are as a firm, how we're looking to address racial and gender-based wealth inequality with accessible, relatable advice and integrating intentional investment options into our client portfolios. NACP is tied to the Morningstar Empowerment Index, right? It is rewarding companies and investing in companies that have great diversity policies, right? The fund itself donates its management fees to the NAACP, and it is an industry-leading performer with its risk score and its actual results. So we love this one.
And I think it fights against, before we jump to alternatives, I think it fights against a narrative that you can't have both. We've been hearing that narrative and push back against, whether it be ESG or whether it be sustainable investing, values-based investing, that you have to choose between great returns and doing things that feel good, that are actually values aligned with the institution or the family. And this is a great example that they actually feed each other and you can have both.
Well said. So this represents US large cap equities, right? We've got a little AI. We've got some sustainability underlying in this fund. We wanted to show you all some private investments as well that we've seen on behalf of our clients. First one being Lafayette Square. Lafayette Square is a private credit fund. It is investing and providing debt capital and credit to middle market businesses that are not owned by private equity companies. Big time differentiator in that private equity company example. And it also is implementing solutions to empower its employees to gain more wealth and gain more financial literacy and benefits after they make investments in their company. So they're really hoping to capture an overlooked segment of the market and really create impact in the investments that they make. They are a minority-owned firm. CEO's name is Damian Dwin. We think he's a visionary, has done great work to bring this product to market. As we look at the risk, right, you can see that downside and upside is a little tighter than NACP's 75, right? So potential downside, a little lower, potential upside, a little lower. To the question earlier about having a diversified portfolio, we wouldn't expect this investment to act the same as NACP during different scenarios that the market may bring, right? If we see interest rates go up, NACP may struggle a little bit. Lafayette Square, because of its floating rate credit that it provides to the companies and the investments that it makes, actually would benefit from a rise in interest rates, right? So depending on the scenario, you know, and the diversification benefits in your portfolio, things like Lafayette Square can really be, you know, can really be valuable in, you know, adding to your portfolio mix.
We've got a question that ties to alternative investments here. Can you talk about Zenith's process in assessing alternative investments?
Absolutely. That's a great question. And you know, I think we want to make sure we take an intentional approach to selecting all of our investments, right? You know, I think private investments warrant a bit of a different process than public investments. There's not as much publicly available information, right? We can see the filings, we can see all the information related to public investments. Can't always see that from a public standpoint. So we take a pretty specific approach. It's a 7-step process that includes an introductory meeting with the potential investment, reviewing document and materials that the investment provides, submitting questions to the provider and the investment firm that are related to what we learned in our introductory meeting and what we reviewed in their documents and materials. Step 4 is reviewing responses, right? Step 5 is repeating step 3 if necessary. If we get those responses, we have more questions, we go back. The last one we did, we had three back and forths with Lafayette, actually probably 4 if you consider our last call. 3 back and forths with Lafayette Square to say like, hey, here's our initial set of questions. They gave us responses. We're like, well, now we have more questions. Went back, they gave us responses. We're like, oh wow, now we have more questions. And then we came back and we said, once we felt good about our questions getting answered, step 6 is creating a memo in a due diligence file. So having a 1-page memo talks about the investment, creating a file that has all of the due diligence materials that we created, our questions, the responses, all the deck and everything from the company. And then the 7th step is making an investment recommendation, right? And making sure that we're taking into account what our client is looking for or clients are looking for and recommending as appropriate. So some of you on this call, we showed Lafayette Square to, we sent over the file, we sent over the memo. If you have any questions on Lafayette Square, now maybe a good time to ask. But that's our process for private investments, and all in all, it tends to take us about 6 weeks to move through that process. Great question. All right, so lastly, we wanted to get into just an example of private equity investment. We just learned about this company, Girl Concrete. They are a company based here in Philadelphia. This represents a direct investment rather than an investment in a fund. So big distinction between NACP and Lafayette Square. Those are investing in funds. We're getting a diversified pool of investments. Grow Concrete is one investment. I can liken this to the question about AI, right? Kind of like, should I invest in AI or diversify portfolio, right? If you do want to invest in AI, maybe it's a very small percentage of your portfolio. Same thing here, right? You're taking kind of single exposure risk. Grow Concrete is a Black woman-owned contractor here in the Philadelphia area. It went from 0 to almost $11 million in contracts in 2 years, and they plan to get to 100 million. They're raising some money to fuel their growth and anticipate some pretty significant earnings growth over the next 5 years. When we look at the risk score, right, kind of that single concentration risk, you could lose all your money investing in Grow Concrete, but you could also maybe triple your money. So the wider the range on that potential upside downside, the more and higher the risk score is going to be, right? That wider range, that wider potential set of outcomes correlates to the risk score. And in this example, right, you're really seeing that play through with the potential loss, but also potential gain. As we look at alternatives, though, I think it's interesting to see investments like this where you could lose all your money, provided you could earn, right? This is what I would consider an asymmetric downside upside opportunity, right? If you're an investor and you put, a small percentage of your portfolio, you lose all your money, right? That's 100%. But, if you hit what we think could be interesting related to their earnings growth and they actually can return your money, you could triple your money. So you could lose one or make three, right? So those are the kind of asymmetric opportunities that I think are important to integrate into your portfolio. We don't want to bet the farm on any of that because, again, you could lose it. Our due diligence process will try to help you evaluate the risk, and this risk scoring is probably the biggest indication of like us saying like, hey, this is risky. But for long-term investors and people trying to have diversified portfolios, risk isn't bad, right? You want to make sure you're assessing and putting risks together in your portfolio that makes sense, not over allocating to one sector or one company, but including risky things in your portfolio that can generate differentiated returns and volatility control. So that's really it. We appreciate this time, and always enjoy these quarterly market insight webinars. Great questions from you all. Before we depart and call it a night, does anybody else have any questions?
We've got a question. How does one get involved with these investments?
Oh, great. Oh, hey, Ashley. Thanks for asking that. Reach out to our team, right? And Ashley, I think it may be back on me in our email thread. I know you asked about this. I'll research that and make sure we get you the memos for these so that you can review them. Okay, all right. Well, I'm glad you joined. Make sure we get you some memos on these and just give you a little bit more information to review. I think our clients are always welcome. Those who watch this, right, reach out. We can't solicit, right? The SEC is watching. We can't solicit any new clients with private placements. So we want to talk about your goals, your objectives. Once we understand your plan and your policy, though, it does put us in a position to be able to recommend alternative investments and really allow you to see the full gamut of what we can offer here as a firm. So thanks, Ashley, and appreciate the prompt as well.
Additional questions? We have one. When does it make sense for alternative investments?
Got it. Okay. Thank you. So yeah, when does it not make sense for alternative investments?
When does it not?
I think alternative investments, can come in many forms. That's a good question, but they can come in many forms. Some of the biggest reasons I would say folks like wouldn't invest in the two that we just showed is because of liquidity. So both of those, you are tying your money up in something illiquid over a certain period of time. For Lafayette Square, it's not that long, a couple quarters. For Grow Concrete, it could be 10 years, right? So if you can't stomach the illiquidity, now again, we're not telling you to put, more than, if any, a couple percentage points in any alternative investments of your portfolio. So hopefully that part of your portfolio does not need liquidity. But if you could need your money, then liquidity is a big consideration. The second is just time horizon, right? Again, some of these are illiquid. They're going to take time to give you investment results as an investor. if you need to receive results sooner for your plan or for your policy, that could be a limiting factor. And then lastly is tax considerations, right? We actually do a decent amount of work with tax exempt foundations and endowments here at Zenith. You know, any alternative investment where you're investing and you're a partner in the business. So think about Girl Concrete. This may not be the case, as their company structure may protect against this. They're a corporation, but if you want to invest in an LLC and you're a tax exempt investor, that actually might not make any sense, because you can't afford to get unrelated business income tax. And you know, I know we have a CPA on the call. I know we have some folks. I don't want to get out ahead of my skis here, but you know, getting that UBIT or that unrelated business income tax is very detrimental for an organization that is a 501c3 and is getting all of its program related or you know, grant or public dollars that are required by the IRS. And you know, earning unrelated business income tax can create a pretty ugly tax situation for a tax exempt investor. So those are just a few areas. There are definitely liquid alternatives like publicly traded real estate funds. I'd consider, like, you know, kind of quasi alternative. Those, you know, I think eliminate that duration and that you know, that tax question. So it depends on the type of alternative. For the ones that we showed, those three reasons are the primary reasons I would say that somebody shouldn't participate in something like that. Great question. All right. All right. Well, look, we had fun, you know. We won't go back to those GPAs ever again. By the way, Andrew,
I didn't see it coming, but it's okay.
I didn't see it coming either. And we appreciate everybody for joining. So thank you for another. If you have any thoughts or ideas on how we can make this better, you know, our core value here at Zenith is continuous improvement. Please let us know, email, phone call, in the chat. We want to make these better and more relevant for you, and tell you what's in it for you and maybe action items and next steps. We tried to lead with key takeaways in the beginning here based on feedback. So if you have any more feedback, let us know. But thank you all for the trust and confidence, and we'll see you next time.